Thank you very much. Yes, we have the all-important panel of regulators. We're going to have regulators from the Capital Markets Authority and participants in that market as well, and as well as the Uganda Retirement Benefits Authority. Join me in welcoming 4 individuals. Firstly, allow me to invite Benjamin Katende from URBRA. Round of applause for him. Tukie from the Capital Markets Authority. Philip Musinguzi, Zamara. The applause, please. And finally, but in no means least, Godfrey Bukomeko from UAP Old Mutual. Yes, getting us underway. This conversation is really about the industries, the two sectors that feed into each other, which is firstly the retirement benefits sector, and then the capital markets sector that feed into each other. Industry data indicates that there's a demographic transition due to declining fertility rates and increased longevity in Uganda. So we're having an older population with us, which causes certain changes in the market. And we're trying to see how well these two sectors are prepared to deal with this demographic change. At the end of 2023, the retirement benefits sector had about 22 trillion shillings in assets under management, which is about $5.8 billion. Of course, the big player there is NSSF, but there are very many other schemes that have come along the way. Looking at the capital market side, there's about 2.7 trillion in assets under management for collective investment schemes, which are about $700 million. Fund managers have about 5 trillion, which is about 1.3 billion. And then the exchange domestic capitalization comes to about 11 trillion shillings, which is about 2.9 billion. So we're going to talk about whether this is sufficient to realize the kind of Uganda we want. There's a lot of talk about Vision 2040, a middle income country where everyone is doing well financially. And speaking to this, I'm going to ask the panel to each introduce themselves and just react to these statistics. Starting with Benjamin.
Thank you, Sanya. I'm Benjamin Mukiibi. I'm head of research and strategy at URBRA. And really, when you hear URBRA, we're just to ensure that members get the best possible outcome. So the approach we take is we question efficiency, we question adequacy, security, coverage. At the end of the day, we want to make sure that even when you make nominal contribution, they are invested, and at the end of the day, you have a good outcome. So the member is at the front of our mind. And when we start raising questions about how best can we drive the agenda of resolving the challenge of old age poverty, we are looking out to see that we get the most profitable mandates. So we have been discussing real estate and all these other options. And really the perspective that we have at URBRA is, regardless of the legal and operational constraints that we have in the sector, we must be mindful about the member. So when we talk about coverage, yes, indeed, the demography shows that we have the youth bulge. So we have so many Ugandans that are graduating into the workforce, and there's potential to get so many Ugandans to make contributions that can turn into investment in the different classes. But the question is, do we have a preposition for value for them? So when we have 10%, 9%, in some discussions I've had in rooms where you have all these CFAs, some things that we can actually do much better than the average return that we get, 10%, 8%. So when you question the 10% and you say, how do we value even the 10%? Are we getting the best, or we could be getting 20%, or we are actually getting less than 10%? So when you tell us that you are giving a return of 20%, we must be confident that it's actually 10% or 20%. So as we look at getting more Ugandans to save for retirement, we at URBRA think that whoever is making that decision to make that saving, we are looking out to make sure that we get a good return. So for now, that's what I can share with you, and I hope we can engage more on this specific on how we see this alternative investments contributing to member outcomes.
Thank you, Benjamin. Over to you, Lynn.
Thank you, Samuel. My name is Lynn Tukie. I am the Communications and Public Relations Manager at the Capital Markets Authority. I just want to speak again to what our mandate is. The Capital Markets Authority was set up by an Act of Parliament in 1996, and our role is to regulate and develop the capital market space. And to react to what Samuel has raised about the statistics, and you can see, for example, the adult population in Uganda is at 24 million. And yet, when you look at the collective investment schemes, for example, as an avenue for investment, we have only about 131,000 Ugandans investing in unit trusts. And so this begs a question, where are the other 23 or so million Ugandans? And so this is something that we are very passionate about in doing, especially when it comes to investor education. So the Capital Markets Authority has actually looked at all these avenues in terms of the partnerships. For example, URBRA here, there is so much that we can work on in terms of the bank accounts that are opened for the, the 12 million plus Ugandans, for example. How many of those are actually looking at unit trust as an investment avenue? And so our role is to basically create that awareness, especially when it comes to collective investment schemes, as a safe avenue for investments. And so ours is to tap into such forums where we can actually be able to spread the word and work with, for example, the CFA Society to make sure that this is taken to the everyday Ugandan, but also it starts with the corporates here, because I can also see that many of us would not have known about the many advantages of collective investment schemes had we not been a party to one or two comrades in this space, for example. So there is a lot of awareness to be done, especially in the investment space. And it's not all gloom, because we have also seen the fund managers rising in number from, for example, 2 to 6 currently, and many of them are represented here. And so this is just a wake-up call to say there is so much to be tapped into. And so as the Capital Markets Authority, not just looking at the investment avenues available for individuals, but also what are the capital raising options. And I'm glad that the theme today is all about private capital. How can we again work together? And you have heard from the different funds that have spoken before the panels, and these are people, or these are what we have to regulate, and we are putting the regulatory framework in place, as you heard from the keynote address given by the director Dixon Sembia, who has actually shown our commitment to actually make sure that the regulatory framework is strengthened. So there is a lot of thriving in terms of the private capital space as well.
Thank you very much, Lynn. Philip, I'm going to ask you to introduce yourself, but at the same time, want you to speak to what you see in the sector. Do you feel empowered enough by the regulator? It's a good time to have a heart-to-heart. Maybe you could just speak to that as well.
Thank you. Thank you very much, Sam. And good afternoon to the attendees in the room. My name is Philip Musinguzi. Just as has been mentioned while I was being introduced, I work for an organization called Zamara Actuaries, Administrators and Consultants Uganda Limited. And our job at Zamara is to primarily undertake administrative work for most of the pension funds within Uganda, but we also have spread outside Uganda. To come to your question, particularly Sam, and just to start off by reacting to the statistics that you've just given, before I can dive into the actual heart of the matter that you asked me to speak to. The statistics that you give paint a very positive picture. You've mentioned that the retirement benefit sector has grown from 20 trillion to 22 trillion. The assets under management by most of the fund managers in this room have grown to about 5 trillion from 4.8 trillion. That's within a space of 3 months. The CISs under the unit trusts have also continued to grow. Other statistics suggest that there's been a growth in the circle space. I was looking at a headline just recently, and the headline was saying that the circles have reached 33,000. So what does this all mean? This basically means that the savings culture within us as Ugandans has improved. There's been a lot of financial literacy that's being spread around. I've just seen colleagues from NSSF at the table there who have been very instrumental, along with other private industry practitioners who have been instrumental in the success of the statistics that we are reading here. But the question, particularly the one you asked on whether we shall be financially free by 2040, is one that is still worrisome. And it is worrisome because the statistics that you are reading are but for a few people. Uganda has about 45 million people who are not, most of whom are not included in the statistics that we are reading out. These statistics basically cater for about 20 million people who are mostly the working population within the country. So is the coverage adequate enough? The answer is most likely no. But also on the question of adequacy and whether this money is sufficient to cater for an individual and make them empowered or financially free at a certain point in time, I think the statistics from NSSF show that this is not the case. So there's still a lot to do. I'm very glad that we're having a conference such as this one. One of the things that contributes to the growth in these assets is ideally the yield that these assets attract once they're in the capital markets. Are the yields that we are currently seeing in the capital markets still sustainable? The answer is probably no from economists, analysts who are forecasting into the future. So everything that we are looking at today, the futuristic outlook on the investment environment is quite interesting and answers all the questions that I've raised on adequacy, whether it's enough money, but also whether the growth of these assets to cater for the adequacy problem is sustainable.
Okay, thank you. We're going to hear from Godfrey. Godfrey works with URBRA. You're the largest, when it comes to collective investment schemes, you are the big boys, so to say. I'll let you speak to that, introduce yourself, and just speak to, same thing I asked Philip. When you, regulation, do you feel there's enough space to innovate in your introduction, Godfrey?
Thank you. My name is Godfrey Bukomeko. It's such a curious seat to be when you have the regulators up here. So my answer will be quite broad, so that I can offer some perspective from what we are seeing at Old Mutual. So before we look at whether regulation is actually suffice at the moment, the question we need to ask ourselves is, what is the value proposition that we're giving to the ordinary citizen out there beyond the CIS? So we are speaking about about the proposition for saving and how that has progressed. But what is the correlation between that and investing? Now, when you're looking at the investment attitude or sentiment, and the panel that was just here before was relating to the Gen Zs, they are actually not only yield seeking or a return seeking, they're looking for a proposition that tends to satisfy all their other interests. Now, alternative investments comes in to help bridge that. Now, Old Mutual in Africa manages a fund in this particular space north of $8 billion, and it's cut across more than just the real estate end. Now, the regulation we have here, while it's still not yet fully formed, is looking at only real estate. But the question would be, as you form that value proposition for the individual out there who is just starting to work or who's maybe in the 8th year of work, you need to then think about all the other channels that would fall under AI. And we are trying to come up with a few products in that line so that the value proposition to the people out there is way broader. And this is in line with the hybrid funds, infrastructure funds. Looking at a hybrid fund would be ideally looking at high yield debt and the mezzanine debt and different, basically to give the citizen out there or the investor out there a chance to invest in asset classes that will be able to return a higher yield if the market go to tank. Now, should the regulation be set up in such a way as to enable that? Yes, well before we even come to market with the product. Currently, you find that the limitations that are put in place, or the limits in place, make it very tricky for different asset managers to actually play in these various spaces. But that is from the value proposition point. Now, from a distribution end, many of us here in the room have seen how Bitcoin trading has really taken shape. We've seen how different people out there are actually looking for fractional ways of participating in these markets. Now, distribution of alternative investments beyond the REIT is something that locally is still baking, but it would be key to push that dial a lot further so that we can be able to onboard them. How would this help the market? The numbers you spoke to they relate to what has happened, not what is yet to come. So with 131,000 members under the collective investment schemes, you realize that there is over about 15 million people that are on the telecoms. If you get the unique accounts, all those are potential savers and potential investors, and they're actually looking out there. Their money is not sitting in the banks. So for the bankers in the room, we wouldn't be even competing with you. This is money that is not in the markets right now, but is seeking for a way to come in. And then maybe to also bring it home, when you're looking at regulation and the alternative investments, you have to note that we would like to not only invest in houses, but we would prefer to invest in projects that we can get to talk about. Say, for example, in Namibia, in Malawi, we have invested in schools, hospitals, things of the like. Just imagine if the Aga Khan hospital that is being put up was actually crowdfunded, and maybe NSF or Old Mutual or the different other houses were supported to partner together to bring that as a product for the market to even invest in at a fractional level. The impact alone would be so broad that even those that are outside this room would be happy to participate.
Truly a long-winded one, as you promised. But to all the panelists here, maybe we need to address the elephant in the room. I think both sectors are dominated by the NSSF. If you look at it's the largest retirement benefits provider, and then I think when it comes to the listed stock, and if you're looking for investors, they're still there. So the question really is, what plans are there, especially Benjamin? You have so many schemes that have come along. Do you see any promise that perhaps we will have competition to NSSF as the big boy in your sector? Are there any? You have a long-term plan. In that long-term plan, do you envision someone being able to compete with the NSSF to provide more variety from the investment point of view?
Thank you, Sanya. I think the issue is not really competitors with NSSF, but to make sure that whoever is operating in this space does it in the interest of members. Because as you may be aware, many times people think about, say, NSSF as a fund, but we must look at it as members' money, not an institution. So when you look at it with that perspective, then you look at Makerele's and all the other 60 schemes as such, you look at it as members' money. And we are saying, what is stopping us from getting profitable mandates that we could get from alternative investments? So at URBRA, one of the things that we are looking at is the design. We have a provident fund model, whereby for the voluntary schemes, when you exit the employer where you are now, you are paid your lump sum, so you exit. So that creates a disruption. Then when you see what we have as midterm access, then you have the notional retirement age of the NSSF, 55 years. And yet, what we are speaking of now, we are looking at committing capital for the long term. So those disruptions are really affecting some of the things that we are discussing here today, because profitable mandates can only be got when you have the long term with no disruptions. Now, when it comes to the way the provident fund model is designed by law, you notice that we do not have a provision for lifetime products. So when you're exiting at 55, then you get your lump sum, and that's it. Then you choose what you want to do with it. And I think the recent study by the NSSF shows it. They're asking people, what do you use your money for when you get paid? The lump sum. People are buying land, they are going back to school, they're improving their homes and all that. Yet the intention of saving for retirement is to make sure that you deal with the contingencies of old age. So the first thing is to look at the design to make sure that we are responsive to the retirement objective, and through that you can see that we can commit resources for the long term that we can get from this kind of arrangement. Now the second one is about, if you look at for instance the trustees we have, the stewards who are making decisions, they have terms of 3 to 5 years, and there's a lot of member activism that is coming up, just like you would see shareholders. If you go to some of the AGMs, you will find that for the smaller schemes, members are asking tough questions and trustees are under pressure to perform annually. So now we are talking about committing to liquid these assets, where you cannot easily get reports every year that you are doing very well. You're making commitments, you expect a turnaround over time, 5 to 10 years. So you see that we must look at the tenure of trustees and also create a mechanism that allows them to be accountable for decisions for the long term. Because if I'm in for 3 to 5 years and I exit and there are new trustees and I made a decision, then I'm out of it. So how do we hold you accountable for the long term? So those are some of the things we're examining. Then of course, one that you're aware about is the investment regulations. Why only in the East African region? Why not beyond? All these are things that we are looking at. We believe that we must create flexibilities that allow us to venture out, because diversification shouldn't be diversification just for its own sake, where you say we're in real estate, but what are we getting out of the real estate? So when you look at 10-year information of some of the investments, be it with the NSSF and these alternatives, even when we have just a small portion out of what we permit with our investment regulations, you believe that we could do better and competition could come in not to compete with a fund, but to compete with value propositions from other jurisdictions. So if members know that we can do better with Fund A or Fund B, members of the scheme will be asking questions. They will be asking Makerere, they will be asking Makerere, why not invest money here and not there? So we want to make sure that we widen the scope of diversification through geography, but this is something we must discuss together and see how we move forward. Now, the last thing we are thinking about is to address the level of segmentation. I know we have the big fund, but with the smaller funds, you notice that employers will have all these small schemes. We encourage them to join umbrella schemes as well, because how far do you go to diversify when you have 10 billion, 20 billion? So we are looking to consolidate such that we have fewer schemes, but very strong to be able to make investment decisions and also mandates that are more profitable over the long term. So for now, that's what we are looking at in terms of what it is we must do internally to make sure that those that are making investment decisions are not constrained by the quantitative limits that we have in our investment regulations.
Thank you very much, Benjamin. I'm about to open the floor to questions, but there's something you mentioned, which is looking at consolidation of schemes, getting smaller schemes and coming together to form larger ones, and then providing unique value propositions. And for that, I wanted to ask Philip. We saw a large turnout for midterm access. Does that perhaps point to something going on in the market? Do we have not enough variety of value propositions? Things like medical, real estate, and other things that people might require their money midterm. So do you feel that there's enough value proposition for the current market? We've just been hearing about Gen Z and all that. Yeah.
All right, thanks, Sam. Sam, you'll allow me to make a rejoinder to my regulator and just add a bit more detail, because the space that NSF plays in is the same space that I play in. You asked what we are doing to become bigger than the NSSF. I think without liberalization being on the table, it becomes very difficult to compete with the NSSF. But what we have done as private practitioners, competing with the same membership as NSSF, what we have done is to then come and compete with them on the informal sector of things. NSSF is put in place by an act of parliament. They have a mandate to collect contributions from all the employers within Uganda, which makes it easy for their asset base to grow, hence making competition very difficult for people like ourselves. I think on the informal sector, we've come up with products, and that's an area, a landscape where we can compete favorably with NSSF. We have empowered that, or we have driven that or enhanced it with ensuring that we drive financial literacy, but also we've looked at our investment strategy and tried to fine-tune it to ensure that it delivers much stellar results or enhanced results compared to the NSSF. The NSSF still is a competition on the informal space because they are now allowed to go for individuals. So it's very important that as we attack this particular space from a return perspective, our return is a much better value proposition than the NSSF. So the investment strategy has changed to be more tuned to higher yielding securities such that we can attract more membership and hopefully in the future become bigger than NSSF. I think I'm also very excited that alternative investments offer much more yield than what we currently see with traditional assets. So with this kind of knowledge exposure, my call to action for the PE managers in the room would be that let us have a discussion with people like ourselves. We are much more flexible to make decisions because of our size compared to the bigger funds. And hopefully that should drive return, but also give us a competitive advantage against NSSF. The question you asked around midterm access, we can come to it specifically. I think midterm access, in my personal opinion, was one of those things that was unprecedented in the world. The cry for midterm access, I would believe, was not because there are not enough financial products on the market, but it's purely because sectors closed. For most of us within this room, we belong to the financial services sector, a sector that continued to pay either partial salaries or full salaries. So we're not really affected by the closure of the economy. But if you take a sector like the tourism sector lost over 600 jobs. And if the NSSF statistic is correct, that over 90% of the people in the working population have NSSF as their only savings, then it only makes sense for these people to actually go to the NSSF to get a part of their money to cater for the basics of life. I think inherently it's a much wider problem with our social security structure. Our social security structure should not only provide for age benefits, but should also provide for unemployment benefits. So for things like this that currently happen in the world or have happened, where you have complete shutdown of the economy, people are then able to go and access their money. In terms of housing and medical that you spoke of, the framers of the URBRA Act envisaged this need, and within the URBRA Act included the use of retirement benefit money to cater for medical expenses, but also a part of that money can be assigned towards housing for an individual. Thank you.
Thank you very much. Lastly, before we open the floor, I'm going to ask Godfrey and then Lynn to speak to our theme, actually. Looking at the prevailing macroeconomic environment, which way forward? Where should retail investors be putting their money? Godfrey first, and then Lynn.
Thank you. First, allow me to have a rebuttal to the two previous speakers. First, NSF is not part of competition. You can view NSF as a client when you're a fund manager. Then two, why NSF is not a competition, and why NSF is not part of the competition, you find that if we innovate the product offering very well and align it with their mandate, NSF would actually be very much a source of funds to really pilot some of the things in the market, to monetize them and bring them up front, so that then the regulators will be able to have something to benchmark on to grow the space. Then on the other side, though it has been thought about at the NSF, when you read their annual reports, there's a whole wide blue ocean that has not been tapped. It's been locked out simply because of access and lack of access and the knowledge. And that is very much wider and bigger than the current portfolio book that NSF has. If you have the same, NSF has been around for a while. If you give the market the same time lapse, you find that the private side of asset management can actually match up and even be bigger than that. Now, in terms of the question that you've asked, what should a retail investor do? The retail investor is one very dependent on what is currently offered in the market. The retail investor is not as sophisticated as many people in the room, and two, has a few characteristics that are not key to us. One, liquidity. They always want their money close to them. Two, they want to make sure that their money is safe, because they play in high risk spaces, and the question has to be, how do we be able to give them those two, so them to be able to have a high return and also have a high liquid investment while they're actually taking advantage of participating in the different investment channels that we know we can bring to them. So it's not really what they should do, it's more what should we do for them. And we've seen significant traction come in, even on products like the dollar fund. The people out there actually asking the questions, and they're very interested. Then lastly, the trustees of the different pension houses, I think over the course of the last 18 months, have been asking persistently, what are we doing to bring alternative investments to them? What are we doing for them in that space? And I believe any fund manager wants to keep a client or to keep a fund within the next 24 months. If you don't have that offering, they will actually have exited, because you can see that they're now starting to ask the questions. They realize that should the yields on the fixed income side start to drop, and this has happened in other markets, alternative investments become a very key asset class, and they want that exposure. Beyond that, I believe the retail investors will also start to appreciate that exposure. Thank you.
Thank you very much. Over to you, Lynn.
Yes, thank you, Samuel. I think before I go to the way forward for the retail investors, I would just like to also let the audience know that the capital markets authority is actually working on a regulatory sandbox, which will actually help with the different innovations that are coming up and that can actually help the market grow in terms of testing out these many products that they keep innovating. And beyond what we have as NSSF as an enabler for investments for the retail investor, we can see, for example, with the midterm access, many Ugandans could easily fall prey to misusing these monies. But with our flagship project, which is the collective investment scheme that we usually try and promote amongst our the public and all the Ugandans at large, we sort of bring it to them that the collective investment scheme is actually something that is safe, as he said, but also we have regulated fund managers that actually make sure that this money and all the people investing their money in terms of unit trusts are actually assured of the safety, because there's such a thing as the custodian, which is normally a bank, which acts as the vault for this money, but also you have a trustee, which acts as a legal eye. And so they're literally the legal owner for these funds when it comes to collective investment schemes or unit trusts, as they're commonly known. So this project is one that is easily adaptable, especially for the Ugandan people. And we can see through the numbers that it has been growing year on. And the liquidity point that he mentions is actually very crucial, because this is money that you can actually take out in under 48 hours. And most of the Ugandans will cry about the illiquidity, for example, in some of these markets, because most of us would want some quick cash. And so we are swayed to sort of leave our money in banks, thinking there are no investment avenues, for example, that can actually help you have this money out as soon as you expect it in under 48 hours. And so these are some of the awareness campaigns that we are doubling down on as the Capital Markets Authority, as our mandate is actually to also increase the investor confidence, to let the Ugandans know that even unit trusts can be the actual bank account that you can actually put aside in terms of investment. The previous speakers talked of the 10 or 20% investment put aside, for example. But most of us have bank accounts and the money sits and it's not actually working. Samuel, there is a term you used for money working for you that you coined today. What was it?
We borrowed from the good Don, who said your money should not be barren.
It should not be barren, yes. So this is one of the avenues that we're looking at in terms of growing the capital market space. So again, just to reiterate, because our mandate is also to regulate the market, there have been so many financial scams or investment scams that have come up, and this is also because of the lack of awareness when it comes to which funds are licensed to get investments on behalf of Ugandans. And so our appeal, at least one takeaway from this, is that there are so many funds that we license that should be taken into consideration instead of looking for quick money, quick returns from investments that are actually not licensed or regulated by the Capital Markets Authority. Our core mandate is to actually make sure that whoever is getting monies from the public is actually licensed or regulated by us or has a no objection. And if you are a business and you are actually looking to raise capital, there are more legal ways to raise capital. And we have the deal flow facility, for example, in partnership with the European Union that the Capital Markets Authority put up, in also partnership with the financial sector deepening Uganda. And we're saying, can we get you investor ready? And there are programs that we actually put you into. I mean, we're just from a 2-day training conference with business owners and trying to let them know of the many investment and capital raising avenues that they can tap into when it comes to the capital markets. So the awareness is still ongoing. We keep making sure that all this information is known to the public. And so we are just grateful for the different sister agencies that we continue to work with and partner with, and also the entities that we regulate. And again, the CFA Society is one of those platforms that help us put our message out there.
Thank you very much, Lynn. Thank you, the panel. I believe there may be 1 or 2 questions. Remy, do I see your hand up? Yeah, 1 or 2 questions? There being none, I wish to thank the panel for the time and for the input that you've given us. I think it's in order to give you one just very brief closing comment, starting from Godfrey and then ending with Benjamin. Very briefly.
Yes, my closing remarks will be really a call to action that when thinking about alternative investments, we need to think beyond real estate, and then we shall be able to, because the members, the people in the room here are the ones with the mandates to actually do this. We need to think beyond the real estate and be able to, and then be able to bring those different other asset classes to the market, and hopefully then we shall be able to capture a bigger part of that retail segment that we do not currently have.
Right. As part of my parting shots, mine will be to the PE managers in the room, or to the managers that particularly look at alternative investments, and is really to welcome them to institutional money, particularly pension funds. Pension funds have been left out of the conversation on alternative investments, but I think when we look at the future, pension funds being part of this conversation is inevitable. The yields, the interest rates that we currently see in the financial markets, most especially for the bonds and bills, are unsustainable. Some of the pension clients would want to benefit from the PE returns that we hear about. It's very interesting that the people that actually invest in the PE markets are not institutional investors from Uganda. PE money is money that is actually coming from outside. So it is like our institutional investors here are not able to see and seize the opportunities that currently exist in front of us. So the call to action is, again, for the PE managers. Please, you're welcome to the pension side of things. Let's have the discussion. Let's be part of the party. Thank you.
Yes, and mine is do not let the money be barren. When you're getting your mid-term access For the Generation X, is it? Please remember, there is such a thing called the collective investment scheme.
It's Gen Z.
Gen Z. No. There's the older ones.
Oh, Gen Y.
They are the ones I'm seeing in the room.
Oh.
Generation Y. Yeah, the midterm access is coming, right? And I think even some millennials are about to. Yes, please think about the collective investment scheme as an investment avenue for starters. It is safe. And as the Capital Markets Authority, we have a list of all the licensed fund managers, brokers on our website, www.cmauganda.co.ug. Please check them out and always check the regulatory status of any entity before investing, especially in the capital markets. Thank you.
Yes, thank you. My parting shots about first. I've heard that trustees are asking, the fiduciaries of retirement benefit schemes are asking about these alternative investments. But at the same time, they are asking the regulator to increase the proportion that they should invest in government securities because they think the rest are not profitable. So you can see it means that the signal we have in the market is telling trustees that they can do better with government securities. So we have a number of those applications about, I think the biggest percentage of schemes are saying, I think we can do better in this space. So why I say that is because one, in our quantitative limits, we have for real estate up to 10%, I think largely NSSF about 6%, then for private equity, it's just 1.6%. So the window is there, but what is stopping schemes from making this decision? So first, it's because they don't trust that these mandates can actually bring them good outcomes, and that is the challenge before us, to make sure that trustees believe, not just believe, but they are confident that even when it is in the long term, we have at least the basic guarantees that we are going to get a value proposition. If not, then they want to look for a level of certainty. So risk management is important for us. We want to make sure that the fiduciaries are prudent. So what URBRA is looking at is, for this class of alternative investment, is actually Prudential Standard Plus, because we expect that those that are running these entities or these funds like the NSSF are prudent, but you know that there are cases when they are not. So we want to make sure that those that are doing this business are able to identify and respond to risks, but also make decisions that they are accountable for, such that members get the best possible outcome. Thank you.
Godfrey, Philip, Lynn, Benjamin, thank you very much. A round of applause for the panel. We are going to recess for lunch. We have a very good lunch. Ruth and team at the CFA Society have made sure of this. I think we will be receiving coupons as we head out. We shall reconvene at 2040 for the afternoon session. Thank you very much, ladies and gentlemen.